Welcome to Group Insurance Daily Pulse, your hyper-focused, data-driven download on the market's critical shifts. I'm Arya the actuary, here to dissect the risk and scrutinize the numbers.
And I'm Dorian, your distribution expert, bringing you the latest innovations and market movers driving ROI and enhancing employee experience. Today, we've got a packed agenda, from carrier financial muscle to disruptive tech and evolving workplace priorities. Let's dive in. Kicking off with some robust financial news that should reassure every broker and employer in our ecosystem. Unum Group's Q1 2026 performance is exceeding expectations, igniting significant investor confidence. BTC Capital Management Inc. just increased their stake in Unum by a substantial 17.3% in Q1 2026, acquiring 14,771 additional shares.
Measurable commitment, Dorian, or a strategic portfolio adjustment reacting to short-term market signals. Let's unpack the core financials. Unum reported an EPS of $2.14, surpassing the consensus estimate of $2.07 by a mere 7 cents. While a beat is a beat, we need to understand the drivers. Is this sustainable organic growth? Or are we seeing favorable claims experience in specific lines? Or perhaps a one-time investment gain? Their Q1 2026 revenue did hit $3.36 billion, an 8.5% increase year over year. That's a solid top-line expansion. But what's the underlying expense ratio? What's the claim severity trend in their group disability or life portfolios that's allowing for this 7-cent EPS beat? We need to look beyond the headline. A 17 points. Arya, you're looking for clouds on a clear day. This isn't just an isolated move, it's a signal. For brokers and consultants, this robust performance from a major player like Unum provides undeniable leverage. It allows them to confidently assure employers about Unum's reliability as a benefits provider, particularly across critical lines like group disability, life, accident, and critical illness. When an employer sees a carrier consistently outperforming estimates and attracting significant institutional investment, it de-risks their benefit selection process. It speaks to a stable partner, critical for long-term employee benefit program continuity and, ultimately, employee retention. The 8.5% revenue growth isn't just top-line expansion. It indicates market share gains or effective premium rate adjustments that are being accepted, reflecting value. This means Unum is effectively managing its pricing and product strategy in a competitive market. The dividend itself is a testament to financial health, signaling a strong balance sheet and free cash flow generation that supports shareholder returns, which in turn reinforces investor confidence and lowers cost of capital. De-risking the benefit selection process versus understanding the actual liabilities being underwritten. The stability you champion, Dorian, is predicated on precise actuarial reserving and effective risk management. An 8.5% revenue increase might be driven by new business acquisition, but what are the persistency rates on that new business? Are we observing adverse selection in these new groups? What's the average case size and the associated administrative load? And speaking of pricing, are these effective premium rate adjustments sufficient to cover the projected claims for an aging workforce or the increasing incidence of long-term disability claims due to mental health conditions? We know those trends are volatile. My concern is whether the current pricing models adequately reflect these emerging risks. A strong balance sheet is essential, but what's the risk-based capital ratio? How does it compare to regulatory thresholds and internal targets? Are they stress testing for a significant economic downturn or a major public health event? The 0.07 EPS beat, while positive, is a marginal buffer against unforeseen claim spikes or interest rate volatility, especially in long-tail lines. We need to ensure that the P&L isn't just strong today, but resilient against the next decade of actuarial challenges and regulatory scrutiny from state departments of insurance and ERISA compliance.
Arya, the market reads these signals. Unum's consistent performance and investor confidence are precisely the indicators employers look for in a stable, long-term partner. It's not just about the numbers. It's about the narrative of reliability and growth that these numbers create in the market.
The narrative is only as strong as the underlying actuarial assumptions, Dorian. Let's move on before this becomes a full-blown reserving committee meeting.
All right, shifting gears from carrier stability to distribution expansion, we're seeing aggressive moves in the brokerage space that will directly impact market dynamics. Inszone Insurance Services has just appointed Jared Strong as regional president for its East region, effective June 24, 2026. This is a strategic play area designed to aggressively accelerate Inzone's geographic footprint across the East Coast and the southern United States. Inszone is a full-service brokerage covering both P&C and, critically for our audience, employee benefit solutions. They're pursuing both organic growth and strategic acquisitions. This signals a significant expansion of competitive pressure and new opportunities for employers in these regions.
Aggressively accelerate is a phrase that immediately raises red flags for me, Dorian. Rapid expansion, especially through acquisitions, introduces substantial integration risk. What's the due diligence process for these acquisitions? Are they inheriting clean books of business, or are there hidden liabilities, unresolved compliance issues, or underperforming P&C or benefits blocks? Each new state brings a unique regulatory landscape. For employee benefits, we're talking about varying Department of Insurance requirements, different state-mandated benefits, and nuances in ERISA preemption. How will Inszone ensure seamless regulatory compliance across potentially dozens of new state jurisdictions? What about the talent integration? Acquiring firms often means integrating disparate operational systems, compensation structures, and corporate cultures. This can lead to churn among key producers and support staff, eroding the value of the acquisition. From a P&L perspective, the initial costs of aggressive expansion, the M&A premiums, the integration expenses, the new talent acquisition can significantly depress short-term profitability.
Arya, the very nature of growth involves investment and calculated risk. This move isn't just about expansion, it's about market share capture and enhancing local presence. For competing carriers and brokers, this signifies an expanding player, yes, but also opportunities. Brokers may see opportunities for partnerships with a growing national player, leveraging Inszone scale while maintaining local client relationships. For employers, this is unequivocally good news. More options, potentially more competitive offerings, and a broader range of solutions for their group insurance and employee benefits needs.
Inzone's full-service model, combining P&C with employee benefits, offers a holistic approach that many employers are seeking for integrated risk management and streamlined vendor relationships. Jared Strong's appointment is a strategic leadership investment, demonstrating a commitment to structured growth rather than haphazard expansion. The ROI on this is clear: increased market penetration, diversified revenue streams, and a stronger value proposition for clients. This isn't just about P&L, it's about strategic positioning and increasing the pie for everyone by making benefits more accessible and competitive. Accessible, yes, but at what cost to operational efficiency and regulatory adherence? The holistic approach you describe, while attractive to employers, can create internal complexities. Are their P&C and employee benefits platforms truly integrated, or are they siloed operations under one roof? The risk of errors or omissions increases if the integration isn't robust, leading to potential E&O claims. Furthermore, how are they managing the distinct sales cycles and technical expertise required for P&C versus employee benefits? The talent required for each is highly specialized. Aggressive organic growth requires significant investment in sales infrastructure, training, and lead generation. What's their client acquisition cost? Are they prepared for the inevitable increase in regulatory audits that come with expanded geographic reach? Solvency isn't just about current assets. It's about the ability to withstand operational missteps and regulatory fines that can accompany rapid, unmanaged growth. My concern is whether the speed of expansion might outpace the establishment of robust internal controls and compliance frameworks.
It's about agility in a dynamic market, Arya. Inszone is positioning itself for the future, offering employers more choice and integrated solutions. That's a net positive for the market and for employee experience.
The market will judge if that agility comes at the expense of stability.
From traditional growth to revolutionary disruption, let's talk about a major funding round that could fundamentally reshape the health and group benefits landscape. Allen, the prevention insurance company, has just announced a massive Series G financing round of 480 million euros, equivalent to about $550 million on June 25, 2026. This funding values the company at an eye-watering 5.5 billion euros, $6.3 billion. This isn't just capital, it's a statement.
Alan reported reaching over 800 million euros in annual recurring revenue, ARR, in Q1 2026, representing a staggering 53% year-over-year growth, and now serves over 1.1 million members. The capital infusion is earmarked for aggressive international expansion into existing markets like France, Belgium, Spain, and Canada, new acquisitions, and, crucially, significant investment in artificial intelligence, healthcare services, and product innovation. This is the future Aria, proactive health solutions driven by AI.
Prevention insurance. A fascinating concept, Dorian, but one that presents an entirely new set of actuarial challenges and regulatory complexities. How exactly is prevention being quantified and underwritten? What are the verifiable long-term claims reductions directly attributable to these preventative measures, and how are those being modeled into pricing? Traditional actuarial science is built on historical claims data and morbidity tables. Prevention insurance shifts this paradigm, requiring predictive analytics on behavioral change and health outcomes, which is an entirely different level of data sophistication and, frankly, uncertainty. My immediate concern is the solvency implications of a company valued at 5.5 billion euros with 800 million ARR, yet operating in an unproven actuarial space. What's their loss ratio for these prevention products? How are they reserving for future claims if the prevention doesn't achieve its projected efficacy? The significant investment in AI also raises critical data privacy and security questions. Handling vast amounts of sensitive health data, especially across international borders with varying regulations, like GDPR in Europe and HIPAA equivalents in Canada, is a massive compliance undertaking. Any breach could lead to enormous regulatory fines and reputational damage, impacting their P&L and solvency. Furthermore, international expansion into multiple countries simultaneously, each with distinct healthcare systems and insurance regulations, is an extremely high-risk strategy. Are they building localized actuarial models for each market, or attempting a one-size-fits-all approach? This isn't just about innovation. It's about managing unprecedented levels of risk.
Aria, this isn't about traditional actuarial models. It's about building new ones for a new era. Alan's 53% year-over-year ARR growth and 1.1 million members demonstrate significant market validation. Employers are actively seeking innovative, AI-driven prevention and wellness programs precisely because they recognize the potential for healthier workforces and reduced long-term healthcare costs. This is a direct ROI play for employers, investing in prevention to mitigate future, more expensive claims. The AI investment isn't a risk, it's the engine. It allows for personalized health interventions, risk stratification, and potentially more accurate predictive modeling than traditional, backward-looking actuarial methods. This substantial funding round provides the capital buffer to navigate regulatory landscapes and invest in robust data security infrastructure.
Changing the equation needs to be grounded in sound financial principles, Dorian. While the concept of prevention is laudable, the actuarial challenge is immense. How are they quantifying the counterfactual? What would have happened without the prevention? This is an inherent difficulty in demonstrating the direct ROI. The potential for reduced long-term healthcare costs is a hypothesis, not a guaranteed outcome, and requires years of robust data collection and analysis to validate. A 53% ARR growth is impressive, but for a tech company, especially one in a regulated industry, it can also signify a growth at all costs mentality that might defer crucial investments in compliance or reserving adequacy. What are their capital requirements under Solvency II or equivalent regulations in their operating markets? Are they adequately capitalized for the specific risks associated with health insurance, especially if their preventative measures fail to deliver the promised outcomes? The integration of AI into healthcare services necessitates rigorous ethical guidelines and oversight, particularly concerning algorithmic bias in patient data usage, which falls squarely under regulatory scrutiny. This isn't just about a healthier workforce. It's about ensuring the underlying financial mechanism of that health insurance is solvent and sustainable in the face of truly novel risks.
Alan is demonstrating that innovation, backed by significant capital, can redefine what's possible in group benefits. It's a win for members, employers, and the future of health.
Or a substantial venture capital gamble on unproven actuarial models. Time will tell.
Finally, let's shift our lens to an emerging yet undeniable trend in employee priorities that directly impacts benefit strategies and talent retention. A recent survey by Mars Incorporated, conducted on June 25, 2026, across 16,000 European workers, reveals a fascinating insight. Over a third, 36%, prioritize pet-friendly policies over traditional workplace perks and other benefits. This isn't a niche preference, Arya. A staggering 71% of workers who would be more likely to get a pet if their workplace offered supportive pet-friendly policies stated they would consider switching jobs if pets were allowed at work. And here's the kicker. 35% of respondents even placed pet policies above enhanced benefits such as parental leave and private health care. This is a seismic shift, particularly driven by Gen Z and millennials, with 41% of 18 to 24-year-olds actively seeking pet-friendly policies when job hunting, nearly double the rate of workers over 55.
Seismic shift, Dorian, or a significant increase in workplace liability and operational complexity. While I acknowledge the emotional appeal and the clear preference among younger demographics, my focus immediately goes to the P&L impact and the regulatory headaches. Firstly, liability. Increased potential for workplace accidents, including pet bites, allergic reactions, property damage, and even slip and fall incidents caused by pets. Who bears the risk? The employer. Does existing general liability insurance adequately cover these scenarios, or will it require specialized riders, increasing premium costs? Secondly, HR and legal implications. Drafting and enforcing clear, compliant pet policies is not trivial. What are the rules for pet behavior, waste management, designated areas? How do you manage conflicts between pet owners and non-pet owners, or those with allergies or phobias? This introduces an entirely new layer of HR complexity and potential for discrimination claims. Thirdly, facilities management. Increased cleaning costs, potential for damage to office infrastructure, noise complaints. These are direct operational expenses that impact the bottom line. While lifestyle benefits are gaining traction, quantifying the ROI of a pet-friendly policy in terms of reduced absenteeism or increased productivity is extremely challenging, if not impossible, with current metrics.
Arya, you're viewing this through a lens of pure risk aversion, missing the forest for the trees. This isn't about direct insurance products. It's about talent attraction and retention, which are arguably the most critical challenges employers face today. The ROI here is in human capital. If 71% of workers would consider switching jobs for pet-friendly policies, and 35% prioritize it over traditional benefits, then this is a powerful differentiator in a competitive labor market.
Employers who embrace these policies are signaling a progressive, empathetic, and flexible work environment, which directly enhances employee experience and loyalty. This translates into reduced recruitment costs, lower turnover, and a more engaged workforce. While liability concerns exist, they are manageable with clear policies and designated areas, similar to managing any other workplace risk. Many employers are already implementing this successfully. For carriers and brokers, this indicates a clear need to expand their consultation beyond traditional group insurance. We need to help employers integrate these lifestyle benefits and flexible workplace policies into their overall benefit strategy. It's about total rewards. A happy, less stressed employee who can bring their companion to work is likely a more productive and longer tenured employee. Manageable with clear policies is often easier said than done, Dorian. The cost of managing that additional liability, both in terms of insurance premiums and potential legal fees, needs to be factored into the P&L. And while reduced recruitment costs and lower turnover are desirable outcomes, what are the specific metrics and methodologies for attributing those savings directly to a pet policy versus other factors like compensation, culture, or career development? We need quantifiable data, not anecdotal evidence of employee happiness. The concept of total rewards is valid, but the weighting of those rewards must align with both employee preferences and the employer's financial sustainability and risk tolerance.
It's about meeting employees where they are, Arya. The market is speaking, and employers who listen will win the talent war. It's a strategic investment in employee well-being and a powerful competitive differentiator.
A differentiator with a potentially indeterminate cost base and an elevated risk profile.
And that's our rapid-fire download for today on Group Insurance Daily Pulse. From carrier strength to market expansion, disruptive innovation, and evolving employee priorities, the group benefits landscape is as dynamic as ever.
Indeed. The numbers are always moving, and the risks are always evolving. Staying solvent and compliant in this environment demands constant vigilance and a clear understanding of the underlying data.
Absolutely. Join us next time for more insights, more data, and more pulse-pounding analysis. Until then, stay informed.
And stay rigorous.